Today, folks, are we barreling toward a recession? Well, this finfluencer clown doesn't care. Up, down, all around, baby. I am a net buyer of stocks because that is what put me in the position I'm in today. Unlike my billionaire friend, Warren Buffett, who has been flip-flopping around on his positions, being a net seller, stacking more cash than Jerome Powell's money printer, but he has made an investment into two new stocks that have led a lot of investors to think that we are heading toward a recession, because these are what we would call kind of recession-proof dividend plays. But I think they're worth talking about today because they play into commodities, and not a lot of people are talking about that side of these businesses. But firstly, Warren Buffett has continually sold stocks, whether it be Apple, Bank of America, Citigroup, net seller, flip-flopper. Heck, I own Taiwan Semi, and he kind of made me a little bit scared when he bought it and sold it. And the guy just didn't pick up the dips when they were most opportune. We don't know if they're coming or going here. He's not even buying back his own damn stock. But what he did buy for sure is Constellation Brands and Domino's Pizza. And I'm confident to believe that he does one of two things. When he starts buying, he either keeps buying, or when he starts buying, he immediately sells. And I think he's not going to sell these stocks, or maybe Todd and Ted. I don't know who made the decision, but I think I know why they made the decision. So if you're on a path to financial independence, if you damn well one day want to retire early, you love looking at recession-proof dividend stocks, consider hitting that subscribe, especially if you like learning new things about the market, because we'll start with Domino's Pizza and why this is such an intriguing commodity play here in 2025. The stock is up 9%, with most of this rallying off the back of the announcement that Buffett was buying in. And it hasn't really done much for the last 5 years from an equity standpoint, but there was a really interesting reason the stock took a massive dip here that goes beyond just the company's underlying business. It has a lot to do with commodities, but currently the 1.26% dividend yield, this thing has been a growth beast. I mean, the likes of PPC Ian should be looking at this stuff. I mean, look at this, going from 31 cents a decade ago to $1.50 today. I don't think there's too many companies out there that have this kind of growth trajectory on their dividends, especially with the growth rate slowing down in many consumer staple brands or discretionary products. Whether you're talking about your British American, your Altria groups, to your Pepsis and your Coca-Colas of the world. But what I'm showing you in this chart here is wheat. Wheat is one of the primary things used to make pizza. I mean, making bread, dough, you got to get a commodity in there, right? And that's wheat. And something really intriguing is if you follow the wheat price over the last 10 years, it's skyrocketed, man, causing the massive part of an inflationary cycle here, basically in the midst of 2022. And in fact, if we look at the Domino's price coming through 2022, after it peaked, kind of following into that, peak of the wheat price, the stock kind of went in the other direction. And then as soon as wheat started to fall off, the price started to recover. And actually, wheat has corrected quite dramatically and is trading quite low right now, right? And I think this plays into the Domino's thesis of the margins they're going to be able to expand on. Now, Domino's operates primarily as a franchise business, kind of reminds me a lot of how McDonald's operates, but we can see the revenues have been incredibly stable off the back of their business model, and it's starting to actually grow again at a nice pace, actually much better than the likes of Pepsi and some of those consumer staples are, which is incredible to see. It's a company that's done quite a good job purchasing shares back, with the exception of the last couple quarters, but they did do quite a few share repurchases. Net income, is starting to get very strong here again, and the stock isn't trading at all-time high. So I can see why Buffett might be getting excited about it. But global pizza demand continues to rise. I mean, the market is projected to grow at a compounded annual growth rate of about 10.89% through 2032. So pizza's in a very strong, I wouldn't say it is a moated business, because obviously pizza, anybody can do pizza. There's pizza shops everywhere, but Domino's seems to have some kind of a brand that people remain loyal to, and obviously I think we're seeing it in the growth and the prices, right? It is a company, though, you can't really look at the balance sheet the same way, with $1.7 billion in assets, but 5.7 in debt. Again, it follows that McDonald's kind of business model of franchising, so these companies tend to have more debt than assets in most cases. But if we take a look at the statistics here, I mean, if you're a dividend lover, I don't think you have to look much farther. You're talking about a company that is mostly institutionally held beyond even the biggest tech companies, 95% institutional ownership with good insider ownership as well. And you're talking about a payout ratio of 35%, meaning it's likely there's going to be some incredible growth rate in the dividend ahead of it, right? So you've got lower commodity prices, meaning better margins on earnings, a lot to look forward to with a company like Domino's. So if we look at Constellation Brands, a beer company, which I have been a bit iffy on the entire, sin stock sector, because in the United States of America, people do not do, sin stocks like they used to. In fact, beer is on the decline, smoking's on the decline. You got to go to the international markets, and it's a shame that Constellation is one of the net importers of beer to the United States, which is going to hit them potentially on Mexican tariffs if that comes into play. And a lot of those fears, I think, is what helped drive the stock down. But, you know, after Buffett said he's buying into it, it popped up also on a nice little percentage point here, kind of not getting close to the gains that we've lost since the beginning of the year, but with a 2.39% starting dividend yield going from 31 cents a decade ago to over $1. Another company that is an astounding dividend growth beast. But like like with the wheat, you gotta get the barley, baby. You're gonna be making beer. You need barley. You got yeast. Everything here seems to involve yeast for some reason. I'm looking at these and I'm like, there's a trend going on here, right? But barley prices also have corrected quite dramatically from the 2022 highs, according to Fred here, the economic data. And we're starting to see correction in a few of these commodities, and it's just neat that all of these things are kind of playing into themselves when it comes to what Berkshire Buffett seems to be interested in. If we take a look at the net income here, they have a hard time getting net income recovery, and it's been quite choppy through 2022. But if we do take a look at revenue, it has been quite stable. Another one of these companies that's very, very stable from the revenue front. But again, I do want to point out that this is a company that, we're seeing 20-year lows in consumptions when it comes to beer in the United States in general. But in Mexico specifically, the beer demand still remains strong. In fact, beer is actually growing in Mexico. And I noticed on the last earnings that they said they were going to focus on their international markets more than the United States, something we've heard very similar to many other sin companies that exist out there, sin stocks in general. But it is also a company that has done a good job at buying its shares back. From an asset to liability standpoint, pretty strong, 22.8 billion assets, 14 billion in liabilities. From the statistical standpoint, if we just take a look at payout ratio, again, another company that's largely held by institutions, and 104% payout ratio. We got to take into consideration potentially some depreciation and amortization costs. I'm not sure why their payout ratio is so high, but I don't trust payout ratios to earnings per share because it's kind of hard to base it on if the company's writing down some of its assets as of recently, which it's likely that's something they might be doing considering the recent earnings, why net income might be down. So I'm curious to see if this is one of the potential reasons that Buffett's going into these companies, because they're very strong brands. I like Modelo. If I do drink beer, I do prefer Modelo, which is something Constellation produces, but I rarely drink. And honestly, I do love pizza, but I usually go to the local shops up north where my parents live in out of the city, because I find these local shops make far superior pizzas. I've never been a big fan of the chain brands, but that doesn't mean these aren't strong businesses, right? So I'm very intrigued to see how these pan out, because they do not seem like the worst things you could buy on the market today, but not things that I'm personally that intrigued by. But we'll see, how this goes into the future. I'm more intrigued still in the tech companies that actually have super huge growth potential into the future. But I'm young. I'm in my 30s. I don't need to be like Warren Buffett. I don't need to be sitting on $300 billion in cash. If I had $300 billion, though, it'd be nice. But I'll pass that question off to you guys. I'd love to know what you think in that comment section below.